All right. Good Thursday afternoon to all of our Phenom Group members and our YouTube audience. My name is Seth Golden, as always. This is our weekly state of the market. We've been out for the last couple of weeks, so we're back. I hope everybody's had a good trading, system in place over the last couple of weeks, but let's get down to business, as they say. Past, present, short term, midterm, long term, regardless of what the price action is in the present or has been in the past. I've always been of the opinion, as long as you are trading on local price weakness with a long term mindset, you should do well, as long as you're also picking good stocks and or sector ETFs. If you're just buying the dip and index ETFs, more than likely you're going to compound your gains well into the future. From sounding more upbeat and optimistic, it's because the price action's been upbeat and optimistic. Amazing how that works, right? Sentiment somewhat shifts as price shifts, whether you're more bleak and pessimistic because price action has been poor, more optimistic, glass half full when price action is improved. And price action has improved basically since last Friday. So just kind of looking at what's going on in the markets here really quickly. We're well off the highs on all major indices. As you can see, the Dow is lagging here. NASDAQ is leading, which has been the theme during this recent bear market rally. Is it a bear market rally or is it a new uptrend? The reality is you won't know until hindsight. It doesn't mean you shouldn't do your due diligence and look underneath the hood of the car, as they say. Look underneath and look at those market internals on a daily and weekly basis. But the reality is, in real time, it's hard to distinguish between a new uptrend or a bear market rally. Here's the other thing I hope everybody focuses on and understands, absorbs, if you will. Bear market rallies are labeled because things get so badly discounted, they foster the idea that it has to get better from here. Repeat that. It has to get better from here. The bear market rally is validated with lower lows when metrics don't deliver on the optimism of from here. The bottom line, from here demands work. In other words, from peak to trough, we've had a 23% correction in the S&P 500, 33% correction, bear market in the NASDAQ, without a recession, with minimal earnings growth, granted, but with also minimal earnings revisions to the downside. We still expected to see earnings growth here this year. Essentially, the difference between a garden variety correction, a bear market without a recession, the average bear market without a recession is a 24% decline, which is basically what we've had in the S&P 500. A bear market with a recession is about 34%. Do the math. If we've already gone down almost 24% without a recession, we've priced in 70%. Yeah, almost 70% of a bear market with a recession. So what's been priced in? Why are the markets rallying now all of a sudden? I mean, are earnings that good? Are they coming in that good? Not really. And we're seeing guidance being lowered as we expected for the last several months. We've been anticipating that, but stocks are rallying anyway. That's one of the things that Goldman Sachs clients have been recently asking. Goldman Trader, the top client question this week was, why did the market not go down in the face of incredibly worsening data? I don't know about incredibly worsening. It hasn't been improving all that much, that's for sure. And as I said, JP Morgan, Morgan Stanley, I mean, both of those big money center banks missed top and bottom line. The stocks are higher today than where they were going into their earnings releases. Why are stocks going up on bad news? Again, it comes down to what's already been discounted. Indeed, we wrote this in our weekly research report this past weekend. Indeed, a lot has already been discounted in 2022's price action. It appears that all of the bad news was already in the stock market after experiencing the worst half since 1970. Sentiment is so bad, it's actually good. Market is a forward discounting mechanism. It's seen these, it's been pricing, a potential recession, a potential downturn in earnings, or less earnings growth for the full year. I often wonder why it is people think, well, the market was down 24% just because. The NASDAQ was down 33% just because. Remember what I said in previous weeks. Literally, nothing has happened this year other than the Ukraine war and acceleration in inflation. But in terms of deterioration in the overall economic structure, nothing has happened. We still have record retail sales. We still have consumer spending at record levels. Personal income still rising. Industrial production is still rising. We have pockets of weakness in the economy, but other than that, nothing has happened. And yet we've had a 24% correction in the S&P 500, 33% drop in the NASDAQ. Just because? No, the market's been pricing this in all year long. Why is the market not going down in the face of incredible worsening data? It already has gone down. It's got to get that much worse from here. Not only does it have to get that much worse, you almost have to have a compounding shock to the economy for that to happen. And that's why we've had a buyer strike all year. I mean, you couldn't get any follow-through days. You had some brief follow-through at the end of March, but that gave way to lower lows in the S&P 500. We've got some follow-through here now from last week into this week. Hopefully that doesn't lead to lower lows, but it goes back to what I was saying here. Bear market rallies are labeled because things get so badly discounted, they foster the idea that it has to get better from here. The bear market rally, though, is validated with lower lows when metrics don't deliver the things that got to get better from here. We've got work to do, folks, until we see improvement in the macro fundamentals. It's still going to be a bear market rally on face value. And that's why we don't have any, aggregate U.S. equity futures positioning. Look at this. I mean, we're at the lowest leverage we've had in years, folks. Nobody wants to be in this market. According to Deutsche Bank, equity futures positioning for asset managers and leveraged funds is now the most short on record. On record. And part of that is because it's a relative performance ratio. It's longs relative to shorts. We don't have much long positioning on a gross leverage performance. And this is confirmed by the CFTC report. I've been going over this with Phenom Group members each of the last couple of weeks. If you click on the link, it'll take you right to it. Scroll down until you see, I'll do this in real time. You got to get past all the foreign currency exchanges. Here, E-mini, nope, that's E-mini S&P 500 energy. E-mini S&P 500. These are futures contracts. These are the asset managers, the institutions, or the commercials, as they're called. These are the leverage funds. That's your hedge funds. The institutions, long, short, spreading, don't worry about that. But long, short, drop down, 1 million contracts. But look how many they have short, 800,000. Right? It's minimal long exposure. Most of the long exposure is hedged, obviously. But look at the hedge funds, almost 500,000 short contracts only 127,000 long contracts. Drift my catch my drift, as they say. All right, we're having some fun here today, folks. Positioning is light, and where there is excessive positioning, it's on the short side. This is funny. I thought that I caught this off of a Wall Street Journal article. CFO optimist, Chief Financial Officer. CFO optimism indexes. The optimism about my own company is okay. It's pretty high, actually. Optimism about the economy sucks, right? I'll be fine. You guys are in trouble. Isn't that always the way? I thought that was humorous. All right. Last Friday. All right, let's see where we are this week. It's Thursday. Going back to last Friday, we had a really robust rally on Friday. Stocks were up almost 2% on the S&P 500. And, well, maybe I'm exaggerating there. I don't recall. What I do recall is that breadth was really strong. We had an 87% up volume day on the NYSE, like really strong volume. And again, it was all about follow through. Well, Monday was looking great until Apple reportedly, it wasn't a headline that they issued. It wasn't a press release that they issued, but Bloomberg reported that they were going to slow their hiring across key segments of their business in 2023. Now, we were up 130 points or so on the NASDAQ. We were up 1% on the S&P. I gave everything back and then some. We finished down, 100 points on the NASDAQ. The headline was about midday and things just crumbled. So we didn't get any follow through Monday. Come back Tuesday, turnaround Tuesday, as they call it, and stocks rallied heavily. We had a 90% up volume day on the NYSE. We were up 3% on the NASDAQ. We were up, I think, 2+% on the S&P 500. So we had an 87% up volume day on Friday. Things got screwy on Monday, which is what this chart says. The average return on various days during the week, Monday's the worst. Monday is the worst. Going back to 1950, Monday has delivered, ever since 1950, Monday has delivered negative 13% of returns for the S&P 500 since 1950. 19% of the gains have come on Wednesdays, but every day is positive except for Monday. And lo and behold, we got the Apple headline on Monday. But again, on Tuesday, turnaround Tuesday, 90% up volume, huge rally. Even though we had the hiccup on Monday, it's hard to say we didn't get follow through from Friday based on Tuesday's robust volume. All right. Where's Lehman? Net percent taking higher than, this comes from the Bank of America. Every month they offer a fund manager survey, or FMS for short, fund manager survey. And as you can see, nobody's willing to take any risk. In fact, they're taking less risk or abnormal risk than they did back during the financial crisis. Literally, people are that scared they're that afraid of the future today, more so than they were in 2008. Maybe it's the fact that we're living through such unprecedented circumstances, unprecedented times, but this seems way out of whack, way overblown. Another one, cash levels, right? Fund managers surveyed by Bank of America, their cash levels are higher than during the pandemic and during the financial crisis. Nobody wants to be a part of this market. They've moved to cash. They're still in cash. They're afraid. What I find so interesting, right? We're like at the lowest VIX level in a couple months here now, and at the bottom of the regime range, and yet people are this afraid. In my opinion, you put this photograph with a definition of the VIX in the dictionary, signifying the VIX is not a fear index. It's not a fear index. It's a volatility index. If it was a fear index, we'd probably be in the 50s, given how afraid people are. Given how afraid people are. Highest cash level since 2001. So put that in your dictionary. Speaking of the VIX, the average VIX, and this is important. I hope you options players, hope you listen and pay attention here, because remember, VIX moves in regimes. And VIX move, recently we found that every time the VIX dropped to 25-ish, it bounced every single time, at least 4 or 5 times now over the last 3-4 months. But now it's below 24 at the moment. Is that the start of a new lower volatility regime? Again, we won't know without hindsight. But here's the thing, right? The VIX, as of a couple of days ago, was 26. Now it's 23 and change. And people are saying to themselves, when you look at options premiums, they're saying to themselves that implied volatility is cheap. And for this particular regime, looking back 6 months, the first 6 months of the year, yeah, it's at the low end. The VIX and implied volatility within these options is relatively cheap. But if it is truly cheap, you have to believe, and the market's going to have to bear it out, that volatility will once again bounce and prove that the current implied volatility is cheap. If we are moving from one elevated volatility regime to a lower volatility regime over the next several months, if not 6 months, you're going to find out that cheap implied volatility today is going to look extremely expensive going out the next several months. It's another reason why you don't do technical analysis on the VIX. You have to recognize the VIX as a living, breathing entity that identifies regimes. And regimes are not constant, they're static. So if you're trading options and you're of the opinion that the implied volatility looks cheap today, think about the future. Think about where we came from over the last 6 months and where we might be heading, knowing that volatility doesn't stay elevated forever, folks. It also doesn't stay depressed forever. All right, risk on, risk off indicator from the sentiment trader. Look where it is. Risk on relative to risk off is at its lowest levels, where it usually troughs several times in the past. 1 month forward S&P 500 returns in the past 1, 2, 3, 4, 5 times it's gotten down to this or around this level have been exceptional. Risk on, risk off. You get down to these levels, folks, and again, it feeds right into here. We're in a regime where how much of bad news has already been priced in? How long do you think the VIX will stay in an elevated volatility regime? The average coming into this week for the year was 26. That is above the historic median, mean, and mode reading. Well above. Things to keep in mind, folks. We've talked a lot about, and a lot of this is sentiment, right? Risk on, risk. It's about sentiment. Do investors want to engage this market, or are they comfortable sitting on the sidelines? What is their sentiment? It got so bad. Remember, we were having, in June, we had market in turmoil CNBC specials. And we noted that after the first market in turmoil CNBC special airs, 1 year later, the S&P 500 has a perfect track record. These are all the first within the year where the CNBC special market in turmoil aired, and the total returns 1 year later. It's always green 1 year later. You could have said the bear market is over back in June when the first airing of Markets in Turmoil for CNBC. You could have said that. So far, you would have been right. It didn't mean that you didn't see lower lows, because in mid-June, we hit, so far, the bear market low. But we had stocks starting to trend up during that time frame. Remember, it's a market of stocks. It's not a stock market. It's a market of stocks. Some stocks will have bottomed and started their rise, their leadership. And if they're large cap growth, they're going to lead the market higher. It's just a matter of when, which may be happening as we speak. Sentiment, terrible. We showed this, I think, in May. Yeah, it was May, because that was the first, in May was the first CNBC Markets in Turmoil special for this year, officially. But we made lower lows in June. But because historically, if you go back to May 5th, find out what the closing price was. We should be up from that closing price a year later. Historically, that is all that's ever happened. Now I'm tempted to go and see what the price was. I'll figure that out later, though. Something else we talked about in our May 8th research report. Remember, we highlighted the S&P 500 put-call ratio, or the equity-only put-call ratio, I should say. The equity-only put-call ratio in this chart right here, and the 5-day moving average of the equity put-call ratio. Every time, historically, that it got to 0.75 on the equity-only put-call ratio, if you had bought then a year later, the market had bottomed and the market was higher a year later. Every single time. The pink ones are when it hit 0.75. The black ones are when it got to, I think, 0.80. And it got to 0.85 in June of this year. 0.85. Is the bear market over? What we know is a year later, the market has been higher every single time it's gotten to 0.75 or greater. We don't need to know where the exact bottom is. What we know is from the moment that we get to 0.75 or better on the equity put-call ratio, every price below that closing on that day, every tick that the S&P 500 goes lower after that signal of the equity put-call ratio, you're just getting value. You're getting the opportunity to dollar cost average, because historically the market has been higher a year later every single time. July 19th, and here you are. This is kind of the updated chart, the equity put-call ratio 5-day moving average. We hit it right here in mid-June. Right there, we got to 0.75 or better, got all the way up to 0.85. Guess what? The market has been higher almost ever since. 36.66 was the low. Ouch. I'm not going to say that 10 times fast. But again, we talked about this back in May. Preparing, right? We need to know what to look for in the market to suggest this is a good time to allocate capital. The bottom is forming. We're in the bottoming process. On May 8th, we started looking at this, monitoring it day in and day out. In June, things got progressively worse in the market. The signal fired. We've been trading pretty hard ever since. The market has been up ever since. Something else we talked about also in the May 8th report, the NASDAQ had in that particular week, from our May 8th research report, the NASDAQ had a 99% down volume day in that week. I think it was on a Thursday. And this study above is a back test of events of 99% down volume days over the last 10 years in the NASDAQ 100. The results going forward, 88% of the time, 3 months later, the NASDAQ was higher, 88% of the time. It's a pretty strong positivity rate. Drawdowns, here's your drawdowns. You could have some drawdowns before you go higher. Always good to rationalize that. But the average return is 9.74%. The NASDAQ 100 coming into today was still below. We're a little more than 2 months into this study. NASDAQ 100 came into today at 12,693. Oh, I'm sorry. The NASDAQ on the day of that study was 12,693. And we were just below. We were 12,400, I think, coming into today's trading session. We still have a month to go in this study. There's still another month to go in this study before the 3-month duration post the signal is met. Why are we revisiting this? Well, because we've already had a substantial rally off the lows in the NASDAQ 100, and the Qs. But this signal tells us we should expect more appreciation going forward. The rally may not be over. When we checked in, we were up 80 points. Now we're up 123. The rally may not be over, folks, according to history. Again, we came into today below 12,693. 88% of the time, the market is higher on it after the NASDAQ 100 has had a 99% down volume day. NASDAQ at a 99, and what did we talk about earlier? Follow-through days. We had an 87% up volume day in the S&P 500 last week, in the NYSE last Friday, and on Tuesday, a 90% up volume day. They're rare, as you can see. This goes all the way back to 2005, and they tend to cluster as well. They tend to cluster. It looks like we've had 2 this year, and 1 was on Tuesday. And you might say to yourself, well, this is momentum, right? There's real money behind this. There's fund flows. And that may be very well true. But the near-term forward-looking returns one day after you've had a 90% up volume day in the NYSE, not that good. And here's the percent of time positive, only 43%. 2 days later, 58% positive. It's a coin flip. 5 days later, coin flip. And the returns are unremarkable. But 10 days later, you got a 1% return. And the percent positivity jumps up to 70+%. 20 days later, almost a full month of trading, 73% positivity, a little bit more return. 30 days later, it starts to get interesting. 3 months later, 65 days is about three trading months, almost a 6% return, 80% positivity rate. So maybe you digest some of that gain that we've had in 2 of the last 3 trading sessions, but there's some real flow behind it longer term, some real flow. There's no 100% here, folks. So maybe this is just a relief rally. Maybe it does fizzle. I mean, we haven't hit recession territory. We don't see earnings falling off a cliff. So we've had a deep correction already. Maybe this is just a big up volume day from a deep correction. And so it seems that much more, like it's going to gain that much more traction. It may not. There's no 100% here. NASDAQ 100 breaks 68-day streak below the 50-day moving average. So something we talked about in this past weekend's weekend research report was the fact that the NASDAQ composite, NASDAQ 100, were very close to having more than 50% of their stocks above the 50-day moving average, with the indices closing above their 50-day moving average for the week. It took 3 months. It's rare. The NASDAQ closed above its 50-day moving average for the first time in 3 months. You have to go back to 2008 to find a longer streak. Again, are we really going into a financial crisis? The 50-day moving average smooths out daily price action and gives investors a read on the short-term directional trend. Short-term. This is a good interim thrust in the market, but it's short-term, folks. We need to think long-term, and we need, this relief rally. If you're bullish on the market, you want this relief rally to find macro fundamental improvements going forward. All right, so what happens when the NASDAQ 100 is finally greater than its 50-day moving average after 3 months? And again, it's kind of the same situation as our 90% up volume. The next day, the average return, okay, not too bad, less than 1%, but problem is 1, 2, 3, 4, 5, 6, 7 occurrences. 4 of them were actually negative, right? So your positivity rate is poor. 1 week later, not so good. Digesting those gains, maybe. 1 month later, again, not so good. A lot of these happened during the dot-com, bust, and in 2002. But 3 months later, it gets a lot better. Percent positive, only 2 negatives, right? 6 months later, again, why I don't like this. The percent positivity and the whole dot-com experience, right? A year later, it's binary, really, when you look at how much red there is in there, although, the average returns are largely positive 3 months to a year out. All right, let's dismiss this one. What I do like is that, and we talked about, a great Friday last week, and a great Tuesday this week. 2 of the 3 days, 2 out of 3 trading days with greater than 85% NYSE up volume within 30 days of the 52-week low. Because we hit the 52-week low, I think on June 16th or June 17th. So we're right in there. This study from the Sentiment Trader, 1 week later, good stuff. 2 weeks later, good stuff. 1 month, 2 months, 100% positivity rate 1 year out. The average return, 23%. What are you doing with this rally here? That's what you need to be asking yourself. What are you doing as an active portfolio manager, knowing we do have 100% here, and quite frankly, we have another 100%er here, because we've already hit greater than 0.75 on the 5-day equity put call ratio as well. We've got 200%ers, folks. What are you doing with this rally? What are you going to do if we do consolidate and the headlines turn against you again? Because they will. The headlines follow, the price action. The financial media follows the price action. Their narratives follow the price action. This is what we talked about in our weekend research report. Stocks trading above their 50-day moving average in the NASDAQ. This is the NASDAQ composite. Remember, the NASDAQ composite is down here at the bottom. Composite down here at the bottom. It made a low with stocks trading above their 50-day moving average, making a corresponding low. But look what happened after. It's been up ever since. This market internal, stocks trading above their 50-day moving average in the NASDAQ composite, started going up, even though the index kept going down, making its low in mid-June. You have a bullish breadth divergence underneath the surface of the NASDAQ composite. Stocks were moving higher. That's why I said earlier, it's a market of stocks, not a stock market. And these are the things you look for to understand where the bear market might have ended. As of today, we have more than 50% of stocks trading above their 50-day moving average. Awesome breadth divergence there. Now, and we've done it before. I mean, went significantly higher here. So you don't know if this is going to roll over. We've had ample time now, though, with this breadth divergence to suggest that maybe the worst for the NASDAQ has already been priced. Here's another one that we talked about in the weekend research report: semiconductors versus utilities. We're talking about a cyclical, a growth area of the market versus a defensive area of the market. And semiconductors have been performing awfully relative to utilities, but maybe they double bottomed. And we had a relative strength bullish divergence, made the bottom here, weak strength at the lows here, but it's been trending higher ever since. And even though this relative performance ratio has made new lows, this bullish breadth divergence tells you the new lows in this relative performance ratio were not, there wasn't a lot of conviction there. It was petering out. Lo and behold, here we are now, folks. Same relative performance ratio. I mean, if that's not a V-shaped recovery, my God, right? I mean, clean breakout of the channel too. Massive breakout there. It got above this plateau level as of yesterday. And now it's just a matter of, is it going to continue? Or is, for whatever reason, this going to prove a false breakout? There's too many charts here so far, right, that tell us there's good things happening in the market, and you need to respect them. In the same way that you respected the downtrend through the first 6 months of the year, you need to respect what's developing in the market today. This is another one: risk on versus risk off, defense, offense versus defense, consumer discretionary equal weight versus consumer staples equal weight. This was just a few days ago from our weekend research report. Downtrend, we might have bottomed, and the same kind of relative strength breadth divergence. Again, offense versus defense. Look at it now, folks. And look at the RSI above 60. Consumer discretionary now outperforming and may very well have signaled that bottom with this break above the 50-day moving average in the relative performance ratio. It's become more risk on. It's become more risk on. Less defense, more offense, more cyclicals, more growth outperformance. Another, the transportation sector ETF, the IYT. Recently, the optics, when the transportation sector optics sentiment 50-period moving average is below 36, which it got to, it has historically signaled the IYT bottom is near. Might not be the absolute bottom, but it's close enough. This signal has generated a return of 35+% in a 12-month period across 7, 1, 2, 3, 4, 5, there might have been a cluster in here, 7 different episodes. And we can validate this in real time by looking at, again, transports versus the utilities, the Dow Jones utilities versus the Dow Jones transports. Long downtrend going back to last year, transports underperforming utilities. And look at this, bottomed here. We had the RSI bullish divergence back in April, even though the bottom wasn't until late May. And now, clean break above this downward sloping trend line. We've eclipsed this lower high here as well. From this point, it really is just a matter of continuation, or will this prove a false breakout? Things will have to deteriorate that much more in the macro fundamentals to prove this a false breakout. All right, just a reminder also, going back to, I think, our early July, our first weekend research report of July, we talked about, if you're still in the business of stock picking, because when you're in a downtrend, you really don't want to be a stock picker. You want to think more about index ETFs. Nonetheless, what I thought I saw so far is value in the market for individual stocks. I listed for our Phenom Group Premium Mastermind and contributing members these 7 stocks. All 7 of them, except, well, I should say 6 out of 7 of them are all higher than when we introduced this weekend research report. 6 out of the 7, the only one under slightly is JP Morgan. We talked about its midterm years. I know till we're like blue in the face, right? But here's something else that we may not have mentioned. In the 25 midterm years since 1930, the S&P 500 has been down 10 of those years through election eve, down 10 times through election eve. In the 12-month period after midterm elections since 1950, the S&P 500 has never, ever been down 12 months later. The average return has been 14.5%. The average gain, if the midterm year has a bear market, the next 12 months, the market is up 28%. November to November. November is midterm election, November of the following year. If you had a bear market, the average return was 28%. Wanted to make sure I highlighted that here in this weekend's state of the market. So with that, we've got some additional data here on the consumer, on retail sales, airlines, right? The price of the ticket at the airline has rolled over. Jobless claims are rising, and again, we want to keep an eye on those, but they're rising from extremely low levels, 30-year low levels. Job openings are still elevated, and we still don't have enough unemployed people to fill those jobs. And then we've got the household debt services payments as a percent. This is basically the household balance sheet, still at the best levels in 60 years, folks. If we're going to have a recession, it's going to be quite mild and probably quite brief. With that, I'm Seth Golden. Thank you for joining me on this week's State of the Market. Trade safely, everybody, and join us again next week.